All right, so my portfolio went down about $300 today, but here's what I did today. So today I closed my Activision trade. So let's look it up here, ATVI. All right, so on August 5th, so this week actually. So as you can see, August 5th, opened August 5th, closed August 9th, so 4 days. I bought Activision at 46.36, but I sold a call option at a 45 strike, collecting $2.70, making my cost 46.36 minus 2.7. So my cost is 43.66, but today I closed it but today, since the stock was trading above my strike price of 45, it was going to get called away if I don't do anything. So to avoid the $25 fee from Questrade for having my shares assigned automatically, I decided to close the trade myself. So to close the trade, I basically just did the opposite. So to open the trade, I sold the call option and I bought the shares. So to close the trade, I'm going to do the opposite, the inverse. So I'm going to buy back the call option, but then the shares are trading much higher. So I'm going to sell the shares. And because we are at expiry date, there isn't that much time value. So I'll end up collecting $45 as if I just let my shares get assigned automatically. But I saved the $25 fee. Instead, I just pay $6. So what I did is I bought the call option for 267, so 0 minus 2.67, but I sold the shares right away for 47.65. I do it in one trade. So basically, instead of letting my shares get called away at 45 and incur the $25 fee, I sold it automatically for 44.98 by closing the trade myself. So basically, I missed out on $2, but I saved $25 for sure. So $44.98 minus my cost of $43.66. So $1.32. So times 100. So this is $132 minus the fees of $12. So $6 in, $6 out. So that's $120 divided by 4,366, which was my capital invested. So 2.7% in 1 week, or even 4 days. But let's just say 1 week. So if we annualize that, that's 142%. So I'm glad I made this trade. I also took care of Weight Watchers. So Weight Watchers, I was stuck at a 25 strike because the stock went to 30 ridiculously. So what I ended up doing is I bought back the call option to close my obligation of letting my shares get called away at 25. And then I sold right away another call option, but this time a different expiry date. So the one that expired August 16, I bought it back and then sold September 20th, also at the 25 strike. But I did that for a credit. I collected, I believe, 65 cents. So basically, in my last video, I calculated that my true cost on Weight Watchers after all the premiums collected is about 25.5. So now by collecting an extra 65 cents, my cost is now below 25, about 24.9. So now come September 20th, if I want my shares to get called away at 25, I guess I could let it get called away. It'll be at cost. I will not have lost money except for the interest I had to pay for holding on to these shares for 5 months. But I basically break even because I sold so many call options while holding these shares. And the call options that I collected, I wanted to see them as income. But now I can't see them as income because basically I lost them by selling the shares at 25 when I actually bought it at 30. Unless the other thing that could happen is come September 20th, Weight Watchers comes back down to 25. So that's a possibility. If that happens, then I'd be in a good position. So I just reduced my cost basis by 65 cents today, and I don't end up losing my shares at 25. But definitely, if that happens, if it does come back down to 25, I'm definitely going to choose a different strike price for the next call option. I'm going to stick to my initial strike price of 28.5 when I initially opened the trade, either 28.5 or 30. Another thing I could have done is I could have paid the $5 or $6 to buy back the call option, but then I would have to add that back to my cost basis. So my cost, instead of my cost basis being 28.5 is the initial strike I sold the call option when I first entered this trade. So if I paid $5 to close this call option over here, I would add it back to the 28.5. So now my new strike price that I don't want to sell below would be 33.5. So I could have done that. So I could have bought back the call option here at the one that expired August 16th with a strike price of 25. I could have bought it back for 5 and then sold a call option at a new strike price much higher at 33.5. 30.5, and that'll be my new strike price from now on going on in the future. And I'll make up what I paid for, I'll make it up when my shares get sold or taken away from me at 33.5 eventually in the future. So these were two possibilities, but because I think I've seen Weight Watchers drop hard so many times, so I think it might drop again. So by sticking to a 25 strike, I have a few, as long as I did it for a credit, as long as I was able to roll for a credit, I think it's not a bad idea. It's going to come back, or even if it doesn't come back, well, I collected a credit. But if I had chosen a higher strike price, if I just bought back the call option and then chosen a higher strike price for the next call option, it would have been for a debit, of course. And I would only get my money back when I actually sell my shares at that 33.5 strike. And who knows, maybe the stock will not reach that. Maybe it'll drop back. So now I'm stuck with a higher strike. But it's good to know that there were several ways to get out of this trade or manage this trade. So for now, I have until September 20th. I collected 65 cents from this, or 65 times 2, so about $130. And hopefully by September 20th, the stock drops back to 25. Come September 20th, if it is above 25, I'll have to do the same. I'll have to buy it back and sell maybe at the same strike if I could do it for a credit. So yeah, you can see it here. I bought back the call option that expired August 16. I bought it for 5.55, but I sold the September 20th at the same strike for $6.10. So I made a profit of the difference here. So about $110, as you can see here. So here's why I love covered calls. Uber today dropped 6%, almost 7% today. And I bought this stock when it was trading at 40. It actually went up after earnings. The stock actually went up the stock actually went down to 39, almost 38. And then it went up to 42, but then today after earnings, it dropped down to 40. And even with all that, I'm actually still profitable, $111 profit. If I had closed the trade today, I would have made a profit of $110. But I didn't want to close the trade because if I hold it on for one more week, I'd make a full profit of about $205. So for an extra $100, I decided to hold on to it for an extra week, to hopefully collect the full potential profit I can make, or even keep it and just sell another call option after August 16. But that's why I really enjoy this covered call strategy, because the stock moves up and down. I don't have to care. I still collect the profit that I expected. As long as it trades, of course, close to the price that I bought it at. If it goes to 30, then I'm kind of in trouble. But at least I reduce my cost basis. So instead of my cost being 40, it's actually just $38. And then I could sell another call option. If the stock is trading at 30, I can sell another call option, to generate some income from a stock that is down 10 or 15% or 20%. So today I bought Mattel. This is a stock that I had placed a covered call trade maybe 2 or 3 months ago. It was profitable, got my shares taken away, so I decided to go in the stock again because it dropped hard today. See, it dropped 15% today. This stock actually went up after earnings, but then this week, as you can see, it's just dropping. It went from almost 13.5 to 11.3 today. So I like it when, big name companies drop. For me, that becomes a buying opportunity. So I bought it at 11.44, sold a call option for 34 cents at an 11.5 strike. This is just 1 week out though. So this is actually a return of 11.5 divided by 11.10. So this is a return of 3.6% in 1 week. So of course, can't complain if of course the stock stays above 11.5 come expiry date. If it's not, then I'll just end up keeping the shares. I keep the 34 cents that I collected, and I could sell another call option at 11.5 strike. But that 11.5 strike is the minimum strike that I can sell call options at, even if the stock goes down, because that's my cost, or that's my minimum selling price for a profit. So if the stock goes to $9, I still have to stick to 11.5 strike, because in case that the stock jumps up to 11.5 come expiry date. So 11.5 is my minimum strike to sell call options at with this trade. Grubhub took a hard drop today. I mean, it was at 69, now it's at 66. But because of the call option that I sold, I'm not in that much trouble. As you can see here, I'm only down $100 in this trade. But guess what? This expires next week, and when it does, I'll just sell another call option at a 70 strike. So I have to stick with the same strike price. and they'll probably collect $2 or $3, which is about 2 or 3%. So not bad. First month I collected about $3. So I bought Halliburton. I'm not sure when. Here, let's look it up under executions. Halliburton, HAL. Okay, so I bought it June 27 for 23.03, and then collected 55 cents for a call option at a 23 strike. Expiring July 5th, so it was 1 week out, collected 55 cents. And then come July 5th, I believe the stock was trading above 23. Honestly, I don't remember, but I ended up buying back the call option for that's July 5th. So come July 5th, the stock was trading slightly above 23. Here, let's look it up. July 5th, it was trading, slightly above 23. So I bought back the call option for 5 cents. So I had to close out the trade, the option that expires July 5th, so that my shares don't get called away at 23 and I pay the $25 fee. So I bought it back for 5 cents. That's what it was trading at. But I sold right away a call option for a little bit over a month. So a month and 4 days out. So maybe 34 days out. I sold a call option at the same strike price of 23, because that's the initial strike price I sold when I got in. And I sold it for $1.03, so collected a much higher premium than the first time. Although the 55 cents was in 1 week, this $1.03 was for 4 weeks. But it's still a decent premium. $1 divided by 23, that's 4% in a month. That's perfect. That's more than I want. While the 55 cents was 2.3% in 1 week. So actually, if we put them together, that's 1.55 divided by 23. That's 6.7% in about 5 to 6 weeks. So let's just say 6 weeks to be conservative. So times 52, that's 58% annually. And now the stock I have at 23, but of course it's trading now at 19.52, like all the energy companies that dropped this week. So it's pretty far from my cost of 23. So now what's going to happen is I'm going to end up keeping the shares, of course. And if I want to sell another call option, obviously I'm going to stick to my 23 strike. I don't want to go far from my cost. So I don't make the same mistake as Weight Watchers. So if I go September 13, pick 23 strike, as you can see here, it's trading for 5 cents. So it's not enough for me to sell after commissions, of course. So it's not worth it. I could maybe risk it, go for a 22 strike, collect 15 cents, but then I'd be doing the same mistake as I did with Weight Watchers. Let's see if I go for 20. Of course, if I go for 20, I'll collect a decent premium. But then what happens if the stock is trading above 20 come September 13? I'll have to buy it back for a loss. So I don't want to do that. So what I could do is stick to my 23 strike, but then I'll have to go a bit further out. Let's say September 27, I'll get $12 or $13. So maybe I could do that. Let's say, I don't want to go to October 18. That's too far. Yeah, so I could probably do September 27, collect maybe $12. But even with commissions, I'll be left with $6. Or I could wait for the stock to come back up a little bit so that the premiums will be better. Or I could buy more shares of Halliburton so that my average cost is lower, let's say 21. And then I could sell a call option at 21. I'll be collecting 46 cents. So that would make it better actually. So it would be 46 divided by 21. I think it's about 2%. Yeah, so that would be 2%. So yeah, that's a possibility. I mean, right now I have 2,300 in Halliburton. I guess I can put another 100 shares if the stock is trading at 19.52. I could put another 100 shares at 19.52. It'll probably drop my average cost to 21.3, about 21.5. And then I could sell a call option at 21.5 strike, so I can collect a decent premium. Because right now at 23, as you can see, the premiums are very low unless I go far, and I don't want to go too far out, or else I wouldn't be getting the returns that I want. So I had a good average starting out with Halliburton. First week, 55 cents, second, and then the second call option for a month, it was $1, but now it's only $12 for another week, for another month. So that's what happens when the stock drops. That's the downside of this strategy. But there's ways to fix it. If you started off small, if you just bought 100 shares, well, if you still like the stock, if you still like the company, you still trust the company, you could put in another 100, giving you a lower strike. Or I could take the risk, I could pick a 21 strike without buying more shares, and then hope that by September 27, the stock does not trade above 21. But if it does, then I'll just have to accept and buy back the call option. I'll add it to my cost basis. So instead of my strike being 23 every time, it'll have to be 23 plus whatever extra I had to pay to close the option. And then for the future months, I'll have to sell the at a strike price of 24, for example, or 25, because that could also work, because the stock won't always go above your strike price. I mean, you could look at the delta. It gives you an idea. So according to this here, the 21 strike has a 32% chance of being reached come September 27. So that means there's a 70% chance that it will not reach 21. So you still have a good chance that Halliburton will not go over 21 come September 27. So in the long run, this could also work. Sometimes you'll have to buy it back and add to your cost basis, but most of the time you'll be on top. So now I've got 1 week left for Netflix. As you can see, I'm losing here $130 on this trade, and I'm probably going to lose almost $300 here. I really need Netflix to be above $320 come August 16th. So that's the downside with iron condors. Alright, so that was a quick overview of my portfolio today. So if you have any questions or any suggestions, leave in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.